One of the more interesting sectors on the market in the last month has been banking. Having been market darlings for weeks and weeks, all of the top four banks had quite a serious correction in the back half of May. Well, joining me now to help unpack this is fund manager Roger Montgomery. Roger, welcome.
Thank you, Ticky.
Now, why has this correction happened, and is it enough of a correction? Because, of course, the Commonwealth Bank, not so long ago, was called the most expensive bank in the world.
Well, and it's arguably still very close. What investors need to understand, despite all the recommendations that they receive from their various advisors, is banks are expensive because interest rates on term deposits are low. And so the proffered conventional wisdom is that you put your money into a bank, own a bank rather than put money into a term deposit with a bank, and you'll end up with a great yield and growth potential. But that theme has caused share prices of banks to push well beyond their intrinsic values.
So you don't believe this analyst talk, and I quote, it's because of the trend following black box quant funds. Can you please explain what that means for our viewers?
That was an email from a broker that was sent around, and we had a very good laugh in our office. The reality is that they're expensive because people have been chasing them for their yield. Eventually that isn't sustainable, particularly if interest rates start going up, and that's not going to happen anytime soon in Australia. But when and if it does, the reality is that these banks, their share prices are much more expensive than their intrinsic values. Yeah. With the exception of the ANZ. The ANZ has fallen the most because I think it's going to take longer for it to generate returns out of Asia that are acceptable to the market, and so it's fallen the most. It's fallen to its intrinsic value. We look for discounts, so we'd need further falls, and the other banks aren't even close.
But it's not due to high-frequency trading or anything like that?
No, I don't think so.
All right. Let me go to another sector.
People use all sorts of reasons to blame their wrong calls on something else, But...
Well, let me go to another sector which is done terribly badly. We're all focused on, of course, iron ore, the mining boom, and even mining services company. But the coal sector has really shrunk, hasn't it?
Well, I don't think people realise that the coal price has fallen not quite as much as iron ore, but almost as much. It's fallen from about $140 a tonne, this is thermal coal freight on board, in 2011 to $80 recently. It's bounced a little to $88. But the things that are influencing the share price are the very same things that ultimately may mean these mega projects are financially unviable.
So like Alpha Coal, for instance.
Yeah, exactly. And China is putting a cap on its consumption. It may cease to become an importer of coal. It may put a cap also on emissions, and those things aren't going away. Now, the International Energy Agency came out with a report and said that the big problem is going to be not necessarily for the coal companies, but for those who are providing handling infrastructure and transport infrastructure. So that means companies like Horizon, for example, the old Queensland Rail. They could have serious financial ramifications, or there could be ramifications as a result.
Well, I was seeing in Reuters that the Newcastle coal exports, the port, have fallen by 15.8% just this week, down to 2.61 million tonnes. Now, presumably, that's going to impact the possible $700 million that Mr. Baird wants for his New South Wales privatisation.
Well, absolutely, and you can't count your chickens before they've hatched, and it's very important to understand that that coal and iron ore are not in a bullish phase, and we're talking years. So even though we saw the prices of some of these material companies rise significantly today, it's a blip, and the story is down for these companies for a while.
So how smart was Gina Rinehart with her sale of her coal assets?
Yes, and a much better price than she would have got now.
So ago.
Exactly.
All right. Now, finally, let me ask you about Leighton, because Leighton have just announced 3 more new independent directors. And I was wondering, one of them, of course, is Vicky McFadden. I was wondering when she was going to jump on a listed board. She's president of the Takeovers panel, amongst other things. But how independent does this now make Leighton?
I think it's an improvement. It's always an improvement to have more independent directors. But let me say this, investors and directors and boards need to understand that if a director, being independent, is receiving the vast majority of their income from fees for being a director, then you could argue that they're more interested in keeping their job than they are being independent. And so there's a real balancing act that they have to undertake. I really think the best thing is to just employ extraordinarily wealthy people who really don't need the fees for being a director, and they're there to do a good job. That's the most important thing, because you can be independent and really just need your job more than anyone else.
Well, we're hearing reports that there are more wealthy people than ever in Australia, so
Delighted
that's
to hear
room
that.
to go around. Roger Montgomery, thank you very much for joining us.
It's a pleasure, Ticky.